presentation.
Yeah.
And I'm keeping the video off so that the quality is not affected much. During the Q&A, I will turn it on.
Okay. That sounds good.
Is it visible now?
Yes, yes, we can see. And it's visible, it's
Yeah.
audible as well. So it's perfect.
Yeah.
So I think
So let me.
with a formal note, welcome Mr. Seshadri for our KISS talk series. And I mean, we have been. This is an interesting topic for all of us, and we have been waiting for a long time to get some expert to talk about funding. So I think who better than yourself, right? So that's great. Please go ahead, sir.
Thank you for the kind introduction, Anil, and for the kind words. And in keeping with the motto of the session, I've kept it simple. I'm starting with the basics, some of the covering some of the probably some of the funding options that most of the startups would have already covered or considered in the initial stages, and then move on to spend more time on what everyone would probably like to know more, which is the VC angel type of funding space and equity funding space. And uh, one another thank you for Dr. Jain for coordinating and requesting for the session over the group. And just as an introduction, I mean, we have discussed a lot in the group, but still, as a formal way of saying, I've spent about 20 years in corporate finance and consulting and strategy in different parts of the world. And I mean, have and recently I'm become a venture partner with our ventures and also an angel investor myself, part of Mumbai Angels Network. And some of the source of funding that you all must be familiar with are listed here, and I'll cover most of these except the loans and microfinance and NBFCs as an option. So we'll start with the more simple one, what everyone would like to think of as easy money. um, First, of course, is bootstrapping. I'm just covering it here because you would have heard the term mentioned and may not be clear about what the concept is. So, uh, the idea is that you self-fund the business. Usually, if you are looking for a product development, you sell services, do some job work, kind of work and build some revenue through that, and use that to fund your product development phase. And it's not really suitable for every kind of business. It's mostly done by somebody who has a gestation period for their development. The second option that I mean, I know most of you would participate in a lot of these hackathons and contests. Um, and I think a couple of days ago we saw somebody getting the top prize in one of the hackathons conducted here. But essentially, the idea is that the general idea is that this is it's a very short challenge. That's how it's usually done, and it's usually conducted by incubators, government portals, etc. On surrounding a theme, and the reward is usually a cash prize, support, mentoring, funding, and the biggest part of it is it opens doors to other opportunities, and it can be solutions to day-to-day problems. But one of the things you should be careful about is that you should retain at least part of the IP, and you should read the fine print carefully here. The other sort of I'm throwing it here as a funding option, but really not. Is It's a shared space offering that you would have seen a lot, at least before this COVID lockdown and everything started. But essentially, this is a real estate as a service, if I can put it that way. Essentially, this would be give you access to common facilities and it is usually a per seat pricing and on a month-to-month basis. And sometimes these are mis-sold as incubators slash accelerators. We'll see what makes it different in the next slides. So this is one of the things that you should be aware of as a startup. So incubator, essentially the idea is it's a real estate plus. You'll have a low cost rental shared space and some admin assistance like a shared space. And usually it's not time based. And as long as you need and as long as the lease allows, there is no set start or end date. And usually the incubators would be around themes such as women in tech, fashion, manufacturing, or similar kind of ideas. And the biggest attraction for this is a strong community element. And you will have usually guest speaker sessions, and there will be a panel of mentors and often a lot of volunteers who spend time, as well as some executives who spend time pro bono. And the accelerator is a completely different thought process. It's essentially the here it's a more fast-paced sort of support, and usually a 3 to 6 month program structured around teaching a cohort business skills and product management skills and lean validation. And the quid pro quo is equity for small cash injection, essentially to carry you through that 3 to 6 month period. And there is usually a demo day or a graduation day where you present your ideas to mentors, investors, advisors, alumni, and the fellow cohort members. And here the idea is to help you, like the name suggests, accelerate your idea into the product stage and get validated by your peers. The other way of funding is through crowdfunding. There are a lot of websites dedicated to this. Kickstarter, Indiegogo, there are a few of them. But these also can be for non-profit sort of ideas as well. Some of them actually have pivoted towards that in their business model. But the idea is to create a community that funds the project, um, and essentially asking for small amounts of money from many people. And the reward offered is intangible usually, and it will be a special access, limited edition merchandise, or early access. And the way to start this is through initially through your contacts, family, colleagues, etc., and then become viral. But the key point to note is there is no monetary return offered in this crowd funding platform, especially from India. Uh, that is not permitted by the law. Now we'll get into the other more common form of funding, which is debts and grants. Like I said, I'll not cover debt in detail. Just want you to be aware that there are different loan schemes that are specific to your startup sector or your industry. And the others are grants like those provided by the startup mission towards at a idea stage or at a productization stage or a scale up stage. And some of the larger companies like BPCL also have a CSR fund dedicated towards this. Now we'll get into the OPM part of it, call it other people's money, where essentially you have to share profits. But before we get into that, if there are any questions on this particular segment, I think that would be a good way to, good place to actually ask those questions regarding whatever we covered so far.
Very true. I think, yeah, so we have about 45 plus people now. So if there are any questions, then probably it's a good idea to have a query with Mr. Seshadri.
Hi, you were mentioned like the crowdfunding is not allowed in India. So can you explain some more on that? Why it is like that?
So it's not that it's not allowed. It is allowed, but you cannot offer a return or a profit sharing through the crowdfunding mechanism, because that will become, I mean, as if you're offering shares, or as if you're offering a partnership in that. So that is the only prohibition, really.
Is there a way to avoid the taxes on this crowdfunded money?
See, crowd-funded money, usually the way it is structured is it is structured as advance against your product or service, whatever that may be, and it's usually treated as revenue um, at the point where you start sending those products off to your customer. So tax saving, uh, that's actually a high class challenge to have for a startup. That's how I would put it. So that's if you're sort of becoming taxable because of this, you know then that means you have grown to a much larger scale.
Thank
So that's actually good news,
yeah,
Ajit.
thank you.
Just to clarify, Arjun, basically, you always pay taxes when you have profits, right? Unless you have profit, you don't pay taxes. So mostly that's all about the money that is coming to you as the revenue, and then your expenses. So whatever is remaining, you pay tax.
Oh, thank you, Basil.
Seshadri, there's a question. There's a not a question, but in the chat box, Hari Krishnan is saying that is there any update relating to the consultation paper SEBI had issued related to the crowdfunding? Is there anything on that you would like to highlight on?
I haven't seen anything come up as a final. I saw it coming up for comments. I haven't seen the final version, but I have been a little less diligent about following news in the last 4 months due to some other work-related commitments. So I may have also missed. So apologies for that.
Okay.
But
No.
yeah,
So I think then we can continue. We can go ahead, Seshadri.
sure. So now let's get into the more exciting part of OPM. But before we get into that, one of the questions, I mean, usually startups or even closely held businesses have this problem when they think about inviting outside investors. Is why should I share profits with a third party who is not part of the business? So that's the traditional way of thinking. But the question, in turn, I would ask in those kind of situations is, which one of these on the screen would fill your hunger better? Whether it's one single piece of the grape, which is the whole part of it, or probably about three-fourths of the jackfruit that is open in front of you. So that's the kind of thought process that you need to keep in mind when you start thinking about uh, an equity funding or a sort of some sort of a profit share based funding. But essentially, the idea is that I mean, this is a little crowded slide, but this is one of the best infographic I found on how to think about a startup to IPO kind of phase. But the idea is that you own 100% of something at the idea stage if you're a startup. And then if you have a co-founder, probably you share it 50-50. And usually the first round, when the I mean, essentially, when you are asking for somebody to invest based on trust, would be what we call as family and friends round. Uh, I mean, some people also call it, F and F being fools and fools around. But the idea is here that you actually go out and have an investment based on trust in your abilities. So that's your first round of funding, and that is usually advisable when you don't have revenue, and you are probably thinking or in the process of developing a product. But we'll see how that plays out in the next one of the slides, how these are looked at, how these rounds are classified. And then The next round would be the seed round, where there is probably an angel investor who comes on board, invests in you. So that would be essentially you will be sharing that probably with your employees, as well as through a stock option pool, your entire equity. And at that stage, your small idea has now become into this two-storied building, and you still own probably about, as a founder, you still own about one third or larger than that, depending on where you started. And finally, by the time you get into a larger Series A kind of round, or after multiple rounds, you'll still own you'll own a smaller percentage of much larger piece of the, or larger uh, part of the business. So essentially, the idea is, when you get funded like this, is uh, your business grows at a much faster pace than your equity is getting diluted. So um, the this is a great way of fueling your growth story, if you think that you can grow really fast. And this is usually, if you think about some of the startups like say Byju's, or the very high profile grocery delivery, food delivery kind of startups, this is how the model works. More money you pour in, you spend that on growth, and the company, or the valuation of the company, grows. Now we'll talk about the first round that we discussed, which is the angel investment, and we'll get into a little bit more in detail in a few of the slides later. But essentially, an angel investment is done by individual investors, and the key part of it is that there is mentoring offered, unlike your traditional investment, where somebody invests money and expects only return from the business every quarter or so. Here, mentoring is also part of the deal. Um, Now, the common way of doing it is through straight equity, which is you allot shares to them, or convertible preference shares, which can essentially, these are preference shares which can be converted into later into equity, or it can be convertible debt. And the more common form of these now in India is iSafe, or convertible notes. We'll probably cover a little bit of this in detail in the next slides. But before that, I want to discuss some of these terminologies that you may have come across. That is pre-seed, seed, different series. Mezzanine rounds is something you may have come across. Just to put everything in context, the pre-seed round is usually the founding team, often pre-product. They receive a small investment to hit, say, one or more milestones, and it can be early stage angels, it can be early startup incubators, or friends and family rounds, like I said. And the seed round is usually a product development and early revenue generation phase. And this is where usually angels and early stage VCs and even accelerators get involved. And after this, usually it's a Series A, Series B kind of rounds, where it is more driven towards revenue growth. And here, super angels, so these are high net worth individuals who invest high ticket items, and VCs usually get involved at this stage. And if there are, and just to clarify on the terminology, usually the way of putting it across is Series A dash. If there are follow-on rounds, and it's a Series AA if there is a new start after a what is called as a down round or a crunch down. Essentially, that means that you raise funds at a lower valuation in one of the follow-on rounds, and then you started again. And follow-on rounds can be Series B, C, all the way to all the alphabets that you can think about. And there are also mezzanine rounds that are sometimes talked about, which are these bridge rounds and pre-IPO loans and debt. These are very uncommon, but bridge rounds are common. And sometimes you will find some of the startups in India call some of these shorter rounds as bridge rounds. Though the terminology is not accurate, uh, uh, the uh, the concept there is that they did a smaller raise probably at a same valuation or a slightly higher valuation. The idea behind that is you can ignore the valuation in that bridge round funding. So one of the cases that I like to highlight in all of these, I mean, where it covers the entire uh, part. I mean, everyone reads about the successes, so I just wanted to cover one of the failures as well. Here, shopclose.com was one of those cases where it got angel funded in 2011, 2 years before Amazon India started, and with a 6 million round. And they did a Series A with a 4 million, Series B, Series C, all the way till Series E, where they were valued as a unicorn in 2016. And then suddenly they hit a lot of roadblocks, partly because of competition, which slowed the growth, and management issues also were there. And they had a failed IPO, essentially, that did not come off. And finally, they had a crunch down round valued at 80 to 100 million in 2019. So once a unicorn, they went for about a tenth of that 3 years later. Um, so, I mean, this also can be the sort of sequence of your fundraise as a startup. And to cover some of the seed round trends, the data is a little bit old, but 2019, 20, I mean, I essentially chose to ignore 2020 data because of COVID related issues, but essentially the the here it covers the median amount and median dilution. I just wanted to highlight a couple of things here. One of that is the median amount and valuation actually changes, and this is valid in the US, valid in other parts of the startup world. That it varies based on the city that you're in. So if you are in, let's say, a Silicon Valley versus one of the, say, Boston versus Charlotte versus one of the smaller towns in the US, your valuation usually and the fund raise could be very different, and each of these could be a tenth of the other in this order. So the same trend can be also observed in India. So, um, but the essential other point that I want to also highlight is that the median dilution is somewhere close to 20%, and these days it would be much, I mean, a little bit lesser than that. And the reason I'm highlighting that is I've seen cases of startups where some of the investors have come in and said essentially that they will fund the seed round, but just for respect would like 50% stake in the company. So that is some a practice that is not anywhere close to the market. Is just what I wanted to highlight. And what do the angel investors look like? About one out of the third, and this is from a survey by Let's Venture, one out of the third are sector agnostic, so they don't have any sector preference, and two-thirds invest in online, mobile, and IT products. And still, fintech, agri-tech, edtech, health tech, and e-commerce to a certain extent in the hyper-local model are in fashion. And 6 out of 7 like to work with founders. What I mean by that is founders can reach out to them, ask for advice, ask for support. Usually, when I invest as a angel, the usual support request I get would be something around the financial area, so it can be related to your area of expertise. And only about a third look for financial gain. Others look for building ecosystem, or uh, getting an idea funded and being part of that journey. And the other part of it is about 30% like to maintain their holdings in the next round, which means they don't like to exit. So 70% people would like to exit in the if there is a next round of funding that happens. And so why do these angel investors fund? We looked at one of the cases, but just generally there are um, about four different sort of outcomes that are possible. One is, you know, what I would call as, or what is generally called as a successful outcome, and the other is what is generally called as a failure. So usually the easiest or the fastest successful outcome for an angel investor would be an early exit, which can happen through another round of funding where they are bought out. Then, and more sort, or I would say less likely would be through a dividend royalty or the company itself buying back shares. And the third would be through a large acquisition, as let's say a large company or a strategic um, investor comes and acquires the entire company, and you get an exit that way. And finally, a successful IPO, which is very rare, and you're probably seeing one of the uh, you know first ones play out in Zomato as it goes public in India. And the failures, it can fail fast. Probably the product did not take off, or the product development did not um, uh, come to a complete fruition. And there could be a failure after multiple angel rounds without booking any revenue. And the third version could be that you would have even VC funding and still fail because the market validation did not happen as expected. And finally, a lot of people call it failure, but a lot of Indian investors don't cut it as a failure. If you talk to them, it would be a cash flow positive business with a very slow growth. That doesn't go into, say, one of the other successful outcomes. So these are sort of 8 different outcomes that can happen for a startup. And the investors should expect the failures a lot more often in number than um, successes happening. That's how the statistics plays out for these kind of startups. And as an example of some of the uh, venture or angel funding groups I work with, I'm just giving you the numbers from their experience. So about 11% of angel funded enterprises in the Mumbai angel ecosystem have raised um, VC funding at the next round, and about 6.7% have provided other exits, and about 18 failures um, essentially concentrated in the Kolkata chapter of Mumbai Angels for some strange reason. Um, and as far as our ventures is concerned, about 25% raised VC funding, and 5% got other type of exits, mostly acquisitions. And there are 60 plus investments and 8 failures in our ventures. So this is our ventures is a much younger platform compared to Mumbai Angels, but still these are comparable sort of matrices, if I would put it. Some of the active networks, you may be wondering, in India, if you are a startup, these are some of the active networks that I've just highlighted that you may want to reach out. In Kerala, Malabar Angels is active, and Kerala Angel Network is getting active these days, after a sort of slumber phase in the initial 2-3 years after it was launched. So IA and Mumbai Angels are the very active networks, and the much lesser active angel networks are uh, uh, probably in the second sort of tier would be G2, Our Ventures, Chennai Angel Network, and there are other sort of localized networks like Marwari Angels, um, Kuber, and a few others that are active in certain pockets. Now, what's the difference between angel funds and VCs? We'll just go through that. The idea is that you should be able to target the right kind of investor for your that are suitable for your startup. So the angel funds, like we saw, would be seed and pre-seed investors. And they can also be investing through a fund registered as an alternative investment fund with SEBI. There are about 8 funds last time I checked that are registered as angel funds. More are getting registered in the last probably 6 months. And VC funds also are registered similarly and have invested, close to 5,300 crores in the 7-year period that I looked at. And one of the very active funds in our ecosystem is the IMK VC fund. And there are other Kerala state supported funds as well. Like we would have seen Unicorn Investments investing in some of the companies. I think it was almost 2 years ago where they invested uh, at $1 million kind of valuation. Now, what makes them different as looking at it from a startup point of view is that one is in funds, investment decisions are taken by a committee. The time taken and process is much longer compared to angel investors. And usually there will be a board member who comes in from the fund, and they may not necessarily be the investor. They could be the professional board member or a professional manager who comes in as a board member. And usually VCs follow a theme or sector, and they usually need a product before they invest. And angel networks have a much faster process. They'll tell you no very fast. They'll have much less uh, paperwork and forms to fill and information required, but they'll still do the due diligence. The usual practice is there will be a board member who leads from the lead investor, and they will also have an observer on the board of the company. Usually they are sector agnostic and diversified group of investors. So the combined investment usually is general type of investment, but there are sometimes trends in these networks as well that you may be able to follow. And usually they are early stage funders through convertible notes as well, not equity only. So you can also see convertible notes, convertible preference share type of investments happening through angel networks. And finally, the investment modes, like I discussed, would be straight equity or preference shares, which are convertible preference shares or optionally convertible preference shares. And it can also be convertible notes or convertible loans. And finally, they can also invest through venture debt. Another area that is actually coming up because of recent regulatory changes, essentially royalty based financing, where the funding happens as a regular investment, and you repay the money through some form of a royalty or percentage of turnover. So that recently got clearance from RBI, and that is slowly picking up. And the process usually is, you'll become part of a search process for the, if you're a startup, you'll look for the investor, pitch at the next stage, share some preliminary information, and you will have some discussion. But before you share the preliminary information, make sure you protect um, your confidential information through either by signing an NDA or putting some similar legal documentation in place. And once you get somewhat comfortable with the discussion, it will move to a term sheet stage, and then based on that, you can go into due diligence, negotiation, and closing. This is the brief overview of the process, and some of the nitty gritties I can cover in the sort of next stage. But I think before we discuss more on the process, it will be worthwhile going into a Q&A.
Uh, Good evening, Seshadri.
Hi, Vinod.
Hi. In one of the previous slides, you asked there, you told that there are other ways of exit.
Yep.
So what are the other ways of exit for a founder or a investor?
For a founder, the only way to exit is through an acquisition, 100% acquisition, or even at an IPO stage, a founder would not be completely be able to exit.
Funding.
Uh, and the other ways, like I mentioned, is through other than an acquisition, would be through say a buyback of shares,
Okay.
which is something that is possible if you are really a cash rich business. And the I mean, the other sort of non-traditional way of doing it is through some form of dividend, or even through some kind of royalty-based payouts. But these are, I mean, these require to be pre-agreed, and these are usually very non-traditional,
Okay.
and very uncommon ways of offering an exit. But the most common is, of course, at the next round of funding or through
Okay.
acquisition.
Yeah, I just want I got curious that when in that share in that slide where you showed the progress of Aventures and MI, you told that 5% of Aventures got exited through other areas. So I was just curious on what the other ways of exits are.
Yeah, so there I think that is mostly an acquisition rather than anything else. So it is usually somebody coming in and buying 100% or near 100% of the company, probably for the
Okay.
product.
So when that happens, it happens through at the present valuation they buys it.
Yeah, at the time of the purchase, whatever the valuation may be, that's where how they exit.
Okay. Okay. So one more question. Sorry, guys. I know that you have other questions too. This due diligence happens. I mean, negotiation happens after due diligence or before due diligence. I know it is it is not. You created it for just information. I wanted a bit more clarity on that.
Yeah, so the reason I have a negotiation after due diligence is the common practice is the before a DD happens, nothing binding is offered. Even though term sheet is offered, there are
Okay.
only about four elements that are binding in a term sheet. We'll discuss that in a little bit, term
Okay.
sheet specific things.
Cool. 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 Okay.
But essentially, the idea is that if somebody offers a term sheet, it doesn't mean it's binding.
Uh-huh.
So, other than confidentiality, price, and any cost reimbursement, and there is a non-circumvention clause that is usually offered. So, or exclusivity for a certain period. Those are the only four binding things in a term sheet. So the negotiation I put it after that is, even though there might be a price offered in the term sheet, that is subject to always due diligence. Whatever comes up in the diligence will become part of your final agreement, whether it's a share purchase agreement or a share allotment,
Yeah.
shareholder agreement that is negotiated. So that is where you actually negotiate binding terms. So that's why I have it after DD.
Okay. 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 That's it.
Hi, Seshadri. Good evening.
Hi, George.
So I had a question about the dilution that you're talking about. What is the generally what is the dilution that an angel investor is looking for under VC? Like, is there like a percentage?
I mean, like I was saying, there is a percentage which is not acceptable, beyond which it is not acceptable. So that's the only thing you need to keep in mind. So if, let's say, somebody asks for more than 20% as an angel investor, that's something you need to be really careful about, and you need to think it through. The reason being, if let's say in the case of one of the investors that I was talking about, or the startup that I was talking about, where they asked for 50%, let's say that is your angel round, and you do another round of funding with a Series A. Now the founder, let's say, even if they hold rest of the 50% in that stage, when that VC funding or the Series A funding happens, they are now holding probably about 30%, and they're on par with the other investor who came in as an angel, and that's not a very sort of
Ideal situation.
not just being ideal, it's not a
Yeah,
fair
yeah.
situation to be in,
Yeah, makes sense.
because it creates a lot of disincentives for the founders
Founder, yeah.
who are running the day-to-day operations. As an investor, I would be wary of that. The second is, and probably another couple of rounds later, they'll suddenly become more like an employee who owns a ESOP. So the incentives become even worse. Um, so that's something. I mean, that is completely not desirable for an investor as well as for the founder of a startup.
Okay, perfect. Thank you.
Hi, Seshadri, Vimal here.
Hi,
First
Vimal.
of all, thanks for the presentation so far. A couple of questions. So one is regarding the process. Practically, what we have seen is like it's not just one investor who comes in one round, right? So you have multiple rounds of investors with a lead investor leading the round, right? So in
Yep.
that scenario, how does the process work when you have multiple set of investors in a round?
Yeah. So, I mean, and thank you for asking that. I was planning to cover it in one of the earlier slides. Somehow I
Okay.
omitted to discuss that. So usually the advantage of dealing with the angel network is that all the investors, even though you are dealing with say probably 20 or 50 who invest their own money, and you have to issue shares in their individual names, they come under a common agreement. So that is one of the biggest advantages in dealing with angel network. So you have one single negotiation to make, and one probably usually a templatized term sheet and agreement being offered and all that. So that makes it much easier. The case where you're talking about with a lead investor and unrelated group of investors coming in, the challenge becomes, I mean, a lot more complex, or the process becomes a lot more complex, because you'll have to repeat some of these stages again and again, because you may have to share information at multiple rounds. You may have to have sort of one-to-one discussions separately, and even the term sheets may not completely come to a common sort of agreement. So you may have to offer different terms to the investors who are funding probably around the same period of time. So those challenges will always be there when you're dealing with separate investors.
Then typically the round closing also takes a longer time, is it?
Yeah. So the round closing, I mean, essentially you have to repeat the process. So that is one challenge, and that makes it longer for you to close. And so even if you are looking for the same amount of fund, if you're talking to five different people, you have to go through and five different levels of discussion, five level, and even diligence where I've seen where even where two different angel networks are co-investing, they may not accept the diligence done by the other, you know, uh, angel network. They may have to do it as part of their own process. So all those challenges are always there, and uh, I mean, this process itself will consume a lot of the founder's time. So you have to be really careful before you get into or start the entire investor process. So um, essentially, your attention will be diverted from the product and market where you should be actually spending most of your time as a startup.
Yeah, thanks, Shadri. Just one more question. So we were talking about the dilution percentage, right? And so related to that, is there a thumb rule on the option pool percentage that we keep aside for the employees? So what is an ideal number, or what is the practice generally in the market?
I think you are now probably going to be governed by the ESOP rules. If I remember correctly, it's 10 or 20% that you can offer as a maximum at a given point of time. So that should be your, I mean, that will govern your max that you can offer as an ESOP. And this is not the single employee offering. This is for the entire pool. So within that pool, you can have any number of employees sharing that 10 or 20%.
Okay. Thanks, Seshadri. I'm
Yeah.
done. Yeah, thanks.
I think we can continue, Seshadri.
Yeah, sure. So, some of the aspects I wanted to cover a little bit in detail was one is the term sheet that I just briefly discussed, and some of the terms that you will come across or you may come across as part of these fundraisers. And the like I said, the usual documentation will include term sheet, and as I was mentioning, there are four things that are uh, only binding in a term sheet. If you see, it's a cost essentially where, let's say somebody says that you have to reimburse the cost of doing the diligence, which is very also not common at the startup stage, but you can also find it being done by some of the investors. The NDA, as in the non-disclosure part of it, and the exclusivity. So there may be a specific period of exclusivity being asked, um, where you may not look for other investors. And finally, the dispute resolution. So if there is some kind of arbitration or other mechanism being talked about, that is also binding. Only these four things are binding in a term sheet. And you may also note that valuation is missing in this. So like I said, valuation is subject to due diligence that happens at a later stage. And the other documentation that you will come across is a subscription agreement if you're issuing new shares, or a share purchase agreement if you are selling shares from the existing investor to the new investor. And finally, there can be a shareholder agreement in place, where it will outline certain rights, and we'll talk about those or briefly talk about those rights in the next slide. And I mean, it can have a lot more complexities. So I would definitely advise you having a lawyer involved at this stage, and a good corporate lawyer involved at this stage. And finally, IP or brand may become part of your uh, agreement if you don't have the IP rights in the correct sort of entity, or if the brand is, say, owned by the founder, or the service mark or the trademark is owned by the founder. All these can be brought into the company through an agreement. And one of the things that I've usually asked most of the startups who talk to me about fundraising, some of you who are in this panel would, or who are listening would actually know this, that I usually ask for appointment letters for the employees, or some kind of an employment contract, whether that has been issued. And the other is inter se agreement. Essentially, what that means is, usually founders have some kind of understanding between themselves that one person will be the CTO, and one person will be the marketing officer or the chief marketing officer, and another person will take care of the operations. So it's a good idea to put everything into at least a white paper and have it signed and kept in your sort of office. The thought process behind that is, usually I've seen where um, some kind of dispute happens, it's usually because of a lack of understanding on these kind of terms. One would be about their roles. Second would be, what would you do if one of the founders decided to take a less active role due to other reasons, or even let's say the one of the founders decided that uh, the startup, I mean, they have other pressing needs that one, I mean, where they have to go to a job or to migrate to a different country. So these are some of the scenarios that I've come across where having a founder agreement in place would be really helpful. So the I mean, one of the cases where I mean, where I'm I mean, I'm being consulted is a group of friends who actually have studied together from school, and one of them decided that for I mean, for some reason that he wanted to um, go with his family to a different country, and he essentially holds a large percentage of that startup. So that discussion, this particular person founder thought that it would be a very easy conversation, but it did not turn out to be that. So, and imagine this is people who you have known for 20 odd years, and uh, I mean, you suddenly have the situation where you are losing friends as well as your hard-earned investment of time and money. So just to avoid all of that and to make it more contract-like, it is advisable to have this founder agreement. It doesn't need to be complicated. It doesn't need to be on a stamp paper or anything like that. It has to be just putting down your understanding, common understanding on a piece of paper. And coming to this shareholder SPA, some of the common terms would be the, let's say, a right to invest or purchase. So essentially, what that means is the shares being offered would be first bought or first invested by this particular group of investor who's signing this agreement, and consent and rectification of due diligence issues. So these would be that, let's say you have, I mean, one of the due diligence finding could be that you have certain agreements that are not in place, or let's say you have unpaid GST amount, or say unpaid taxes, or some licenses are not renewed, etc. So this would be all about rectification of those, and some of them might go into conditions, representation, or warranties, or similar kind of you know major adverse events kind of clauses, where you will say that as a founder we warranty or we underwrite or we represent that these things are uh, done right in the past, and if anything happens, we'll indemnify the investor who has come on board from any damages, or essentially that would be the idea behind the condition or a MAE type of a clause. And in the shareholder agreement, you will find clauses related to transferability. So essentially, it could offer right of first offer or a right of first refusal. So what that means is that you have to either offer the shares to the new shares to the investor who has come on board whenever there is a subsequent issue, or they have the first right of a refusal. So the new shares after their refuse can only be issued to new shareholders at the next round of issue. So some of this is already governed by the Companies Act, but the agreements might specify more stricter requirements. And there will be something known as tag along rights, essentially where the founder, if they sell, the investor also has the right to sell shares to another party. So they have the right to tag along with the founder. And another group of clauses would be related to board rights, essentially who can nominate um, a board member, how many can be there, whether they are executive director or non-executive director, whether they can be part of any committee, or like I said, they can be an observer in the board as well. And whether a quorum in a board will have to include them, these particular directors, to consider certain matters. So let's say you have Mumbai Angels investing and they have nominated one director, and usually the quorum might be that it's two out of three directors for a company. And but specifically the agreement might say something like where certain matters like expansion or investment of company money is discussed, the Mumbai Angel board member has to be part of the quorum. So regardless of whether you have two other directors present, without this director present, you cannot discuss those matters. The other group would be related to veto rights. Here, one of the board member or even the investor saying no to a resolution would kill that resolution, regardless of who owns the majority. And the other group of uh, rights that would be protected for the investor would be exit rights, whether they have the drag rights. Essentially what that means is the investor can be dragged into has the right to be dragged into offering an exit, and whether they have a put option, essentially where they can at their option sell the shares to the new investor. And one of the common two clauses that you will find is anti-dilution, which is again protected by the Companies Act now, where you cannot dilute an investor, existing investor, by issuing new shares. The Companies Act has protection in the form of certain additional procedures for issuing shares to a third party, and whether they have any preference when a liquidation type of event happens. So let's say the company is winding up, whether they get paid first before the founders, etc., can be spelled out in the shareholder agreement. So these are some of the more common things that you will find in an agreement these days. There are a lot more creative ways of writing shareholder agreements, very creative clauses that you can find. So we can discuss these segments before we. I thought I would cover a little bit about SME listing probably in the last 5 minutes, probably after the discussion. So now we can have a Q&A on the process and the agreement part that we covered.
I think Seshadri, from the group that we have, right? So I don't think any one of us have gone through this cycle yet. So it's a part of a learning for us. So probably that's what I see, that there's no questions being asked. Terminologies are pretty Greek and Latin, but we are learning it, right? So that's where probably there's silence. But I'll leave it for the audience to ask questions.
Yeah, no, the reason I opened it for question at that stage also is, one is it's a logical place to stop. The second is I know some of the startups have these kind of questions. Some of them have actually asked me directly over WhatsApp about some of these terms that
Okay.
some of probably an investor offered or talked about some of these, probably not in this technical language, but essentially that was what they were asking. So I thought there may be one or two who might like to discuss this here.
Yeah.
Yeah, and just to highlight that part of the discussion, one of the only, if you take only one key takeaway from this particular segment that I covered, is that if you that I would advise is the co-founder or the founding team agreement that you should have in place. That is something that you should actually start thinking about if you don't have it at this time.
Sheshadri, one question that I have is from the previous section, not from this one. So the valuation need to be done by the time of due diligence, or that need to be done as a part of due diligence, or should we have a valuator do that valuation and show that to the interested parties? How does that work?
So Vinod, you opened a little bit of a complex topic, but essentially the reason I'm saying it is complex is that usually what happens is, and this is a very common practice, and I'm usually at the receiving end of this all the time, being a registered valuer. What happens is the founders have a negotiation. They have a term sheet being offered to them. The DD happens, negotiation happens, And at that stage, they'll go with a checklist to their, or they'll start discussing with their chartered accountant. So the chartered accountant or the expert advisor, financial advisor who discusses with them will suddenly say, "Oh, you're issuing new shares to a third party. Now you have to get a valuation done by a registered valuer." So that is where usually the scramble happens, and usually I'll get a call saying, "Look, I have a limited budget, but I have to comply with this because I just have to comply with this. Need a valuation certificate, and we have already agreed on a price, which is this number. So you have to give us a certificate in the next 1 week for us to help close this." So that puts us in a very as a valuer, that puts us in a spot, because our valuation might not be anywhere close to what the company has agreed to sell to the investor, or to raise from the new investor. I mean, it can happen for a lot of reasons. One is usually that the more fashionable sort of industries get command a premium. But the challenge becomes that, one, if you are a DPIIT registered startup, it is much easier because we don't have to worry about income tax related issues and all that these days. So it can be a much simpler process. But if you're not DPIIT registered, you don't have a startup registration number, it becomes even more complex, because now you have to get or your registration period has expired. Now we have to get a merchant banker involved. Now we have to get two valuers. One is a merchant banker, another is a merchant banker who is SEBI accredited, and the registered valuer under the Companies Act. Uh, Both of them to agree with the valuation or the price agreed by the investor. So that's where it becomes a lot more complex, and you don't have the time, you don't have the budget at that point of time, because you are going through a checklist as a startup. And so all those complexities arise. So the ideal way of doing this is consult with the valuer, get a preliminary sort of valuation done at the stage where you are going to go to an investor, or where discussion you feel that it is reaching a final stage. That is what I would recommend. And the only challenge would be that the valuation will have to be issued sort of like a draft form, and then finally the final signed report might be issued at a later stage. So at least at that point of time, you have a comfort. The reason I'm saying this is all complex is, taxation wise, it has been made a lot more complex these days, because if you issue shares at a price that is not certified by a valuer or a merchant banker, like I was talking about, if it is higher price, the difference, if it is more than say 10%, it will be taxable in the hands of the company. And if it is less than 90% of that valuation number, it will be taxable in the hands of the investor, because the income tax department looks at it as some sort of way of you know transferring money across different group of people. So that's the whole complexity that you just opened up.
Yeah, I understood. Understood. I haven't talked so far with a person on the other side of the valuation. So again, sorry for dragging. As a valuer or a registered valuer, what method you normally a peer-to-peer or a discounted cash flow, or what is the most common way, or what is the practice that you have seen?
So, I mean, regarding, talking about startups, there is I mean, most common way of sort of valuer signing off a report is to use what is called as a venture capital method. Essentially, the way it goes is, we'll take whatever projection you give, apply a very high discount rate based on our evaluation. It can be 50%, it can be higher, and say that your cash flows are risky based on our judgment. So we apply this high discount rate and come up with a valuation number. So that is sort of a market practice. But for a more stable or more regular type of business, which has at least some amount of revenue, some profits, the methodologies are a lot more established, and there are standards governing that internationally as well as nationally. So these are the two different approaches, broad approaches that take place. But within that, like you mentioned, we'll use DCF. Um, we'll use a comparison of peer type companies. So one of the things I would do as even if I'm using a venture capital method is sort of do sort of sense check based on similar type of companies at than I mean that are very similar to the startup that I'm looking at. I know most founders like to say that their startup is unique and all that, but there are always comparables. You can, be a base of adjusting that to, uh, you know, uh, become comparable to the startup that we are looking at, and look at how they have progressed. So let's say take a food delivery startup that comes across today. We can easily look at how Zomato has progressed, and how their valuation has been, and use that as a comparable, just as an example. Everything might not be comparable to a Zomato model, but I'm just saying that could be one of the ways I would do it.
Yep. Over and out.
Hi, Seshadri. This is Arish. I have heard that there is usually a checklist with which the valuation is done. Can you enlighten on that?
Yeah, Arish, your knowledge is correct. Usually, the checklist, it's not a checklist. The checklist varies by valuer to valuer. And the checklist would be more relevant for a uh, more established company than a startup. For a startup, it's very hard to put together a checklist like that. And just based on my experience working with startups in the developed market as well as in India, that's something very tough to do for a startup because you don't have a predictable way of doing it. But if your interest is more towards understanding what kind of checklist it is, there is one very exhaustive checklist called, if you just search for NACO, NSEVA checklist, you will find a very long document which covers essentially it's a series of questions that a valuer is supposed to ask a business owner or the executives in a business um, when they're valuing a regular type of business, not really a startup, but a regular type of business. And it's a old sort of checklist that's out there, and it's more common for a US type of, more developed type of market.
Okay. Thank you.
Hi, Seshadri, Azad this side.
Yeah, hi, sir.
Can you spell that out once again, the checklist?
It's NACVA.
NACB.
Yeah, NACVA short for National Association for Chartered Value or Certified Valuers of America.
Okay. NACB. Okay, thank you, Seshadri.
It's a PDF document, and I'm sure it's available still.
Hi, Seshadri. This is Meera here.
Hi, Meera.
I wanted to ask you, when you do the first round of valuation, that is at the seed level or a pre-seed level, how do you go about it? Is it through the same, what you said, the sense valuation with?
Yeah, so the seed level and even at the product development level, that is the approach where we apply a large discount rate, and for my comfort, I look for similar kind of startups. And I know you come from somewhat this background, so there is a little bit of research done around this area that's fairly new, where somebody looked at idea stage what should be the discount if they are at a certain type of product, and if they are at a sort of product development stage or prototype stage, what should be the discount and all of that. And that is one basis for this. The other basis is uh, the I mean, lot of especially pharma and similar type of startups where the valuation is done use a option based approach, where usually, I mean, Black Scholes is very rarely used as a model for that. Usually it's a binomial type model that is used for those kind of valuations. But those are, I mean, too technical for this audience. I mean, I would not go into detail on that.
Okay, thanks. Got it. But there are instances where I see sometimes a micro VC or some institutional investor announces, okay, we'll give you 20% for an X amount, or an X amount for say 10% or 15% or 20%. They give a ratio and keep it that as a fixed component, irrespective of what the business is. Then how does it come about? I mean, like, okay, it might be, I do understand that it is that investment thesis of that particular institution that's looking at it that way. However, how would you, evaluate in such a situation, treating all the, to put it bluntly, all the horses and asses alike?
Yeah, sure. I mean, it's a challenge, really, because, I mean, like I said, the process now is you agree on a price and then come to the valuer and get a valuation to match that. So, as a professional, I would say that there will be a day when all the chickens come home to roost. Where and these are part of public documents. I mean, a lot of them actually file this as part of their pass 3 or one of the filings, where they say that we have gotten it valued, even though that's not mandatory. A lot of them are filed, so it becomes part of a public document, and there will be probably a day where somebody loses money and it becomes part of a court process, and all of this will be looked at. But like I said, it's a challenge to come to meet to those. But uh, coming back to the first point that you were talking about, percentage for this X amount, um, those are usually the headline news. The way, I mean, I had a prof in IIM who used to say that you name a price, I will tell you the terms under which I will invest. So what he means by that is, you can name any price for anything, and he'll change the terms in such a way that it becomes for him. So that is exactly what is happening with some of these investments. So you will only see the percentage and the, but the exact terms, the rights underneath also have some value to those. So let's say you have attached a put option to, as in you are saying that in the agreement that I have a right to sell these shares if certain things happen, or uh, if certain things don't happen, the founder has to buy these shares back. All of these have a certain value attached to it, which might increase or decrease the valuation of the shares. So just going by the the headline numbers which say 10 million for 10%, it doesn't usually translate well, because these shares that are issued to this particular group may not rank in par on par with the shares that are issued to the founders or that other investors hold, or even the subsequent investors hold. So all of those make it a little bit more complex and a lot more than what the headline numbers talk about.
So thanks. So in effect, it is a risk return matrix that one has to read on the term sheet as a function of whatever they say.
Yeah, risk as well as you have to look at the optionality involved in all of these. So, I mean, without getting too technical, but let's say you have a right to essentially right to refuse, right of first refusal. That is part of any private company shareholding. But that actually has a value for an existing investor. Um, so as part of your holding, that right to refusal, you have to put a value to that and add to your shareholding, or the value of your shareholding, to come up with the correct valuation number.
Great, thank you.
Hi, Seshadri, Azir this side again. I have a question regarding valuation. So when you're starting up, you are not much aware about, how the valuation or things go around, and you are much focused on the product or the business itself. And while raising, friends and family round or pool, uh, uh, how important is this valuation and certification of this valuation when it comes to future, funding by angels and VCs? Or can you fix it in the later stage?
A lot of things can be fixed at a later stage, but there are certain things that can't be fixed. One of the common things, I mean, it's not a valuation related. I mean, most of the valuation related mistakes you can always fix, especially if it is F&F kind of round. Because you can always say that that person is my uncle, therefore we should hit at par, and that is the end of the discussion. There is nothing. Or you can say that you are desperately looking for funds and he came to help us, and that can be a good rationale for your first round of funding. But some of the things that can't be fixed, one is the percentage of dilution, if you dilute a very large percentage. Second is, if you um, if you sort of crowd fund it with very diverse group of investors, where you don't, you cannot really negotiate, or where you have essentially diluted more than 50%, but to a very large group of people. I mean, those are the kind of situations where it's hard to come out of. But everything else, you can always, especially valuation related and all that, you can always come out with a good, decent explanation and good rationale. And it's a very common practice at F&F round to issue shares at par, because you're looking for funds, you don't have the technical knowledge, etc. So, and just for the benefit of the startups here, if you're looking at an F&F round right now, the best way of doing it is through a convertible note, and it can be very easily done. You just go to 100x VC site. They have 3 or 4 different formats there. Take one of them, make it suitable for your requirement, and issue against that. So you don't have to get a valuation done. You don't have to worry about that person being a shareholder at that point of time and all that. So that's a very simple way of taking care of that problem.
Sure, thank you.
Seshadri, we have got 10 more minutes. So,
Yeah.
you can.
Sure. Next section will be very quick, because it's something that I want to offer to startups as a vision that you keep in mind, or that you keep in your sort of journey. Um, so there is this SME listing platform that is coming up in BSE as well as NSE. BSE SME, or NSE Merge is the name of the platform. And it might, right now, you might be thinking, I'm a small startup. Why should I think about listing IPO? That's a very complex process. Getting listed in the market and all that. But this is another sort of, I would, I wouldn't call it a backdoor, but essentially that is what you're being offered to get listed onto the main exchange. The criteria is much simpler than your main BSc or NSE board, where let's say Reliance or Infosys or other companies are traded. Here the criteria is much simpler, and both the exchanges have somewhat similar criteria, except for the the specific criteria on what can get into the board. So it's a very similar criteria, if you can see. And so I just want you to keep this as an option when you grow. And essentially, if you cross a, a decent sized turnover, and if you essentially cross a 3 crore kind of net worth, which is share capital plus reserves, and I mean you have a decent turnover and you are making profits, this could be one of the options for you. So with that, I would like to wind up today's presentation and open to more questions.
Thanks, Seshadri. Can we come out of slide share? Fantastic. So open to questions.
Hi, Seshadri, Vimal here. So one question regarding the entire time frame for the process. So based on your experience, let's say from giving an impressive presentation and getting accepted, okay, how much time does it take to complete the entire process and have the, let's say, the cash hit the account?
Yeah, Vimal, that's a good question. And so one of the usual advice I give for a startup starting in that sort of journey where they start looking for investor, or even as SME or an NBFC for that matter, would be that have an 18-month time frame, and that is very commonly talked about. The idea behind that is, I mean, you could have a lot of false starts. You could actually go to a DD stage, and you know, things might not happen. Funds might not hit the bank for a lot of different reasons. So have an 18-month time frame, have enough cash or sources in the bank where you can keep your startup funded, or have alternate plans in mind before you set out on the process. I mean, it doesn't take 18 months. That's not what I mean, but that is your conservative type of time frame. Usually, a sort of angel round can be closed from the time you pitch to sort of having the um, you know fund in the bank from anywhere from 3 to 6 months. It can be even shorter. Recently, we closed a round for a startup at our ventures, which was much shorter. We are just signing the SPA right now, and the funds would be in the bank probably by the end of the month. So that is shorter than 3 months for that particular startup. So you can have good things happen to you, but be prepared for a longer sort of time frame.
Okay.
Seshadri, one of the questions asked by one of our participants is, why is that angels and VCs always have an affinity towards metro-based startups? Or have they started investing in tier 2 and 3 cities like us?
Well, that metro-based thing was probably true about 4 years back. Right now, there are these, the way angel investors are divided would be that there are the India startup investors and there are the Bharat startup investors. Essentially, what uh, uh, that is meant is that there are the startup investors who look for you know, let's say an Uber of, as an example, Uber of India, or something that is working in the developed markets, that is targeted toward the metro type of crowd of, let's say, 50 to 100 million Indians. So that's the India startups that we are talking about. The Bharat startups are the group, the angel group, which look at only startups which target the non-metro type of India, which has a much longer sort of positive tail, where the emergence of middle class in other markets and all that is adding towards a large market population. So one of the angel groups, native angel investors, clearly talk about this as their investment thesis. And like I said, there are a lot of smaller city-based startups which are looking at tier 2 and tier 3 cities. And startups actually come to the larger networks like Mumbai or ventures from very small places. Um, uh, I mean, like, you know, very small cities in the Hindi belt that probably some of us would not have even heard about. There are startups that are coming up from there. I mean, these could be simple things like, you know, a two-wheeler garage support, or delivering groceries to uncovered villages, or villages that are hard to reach. So solutions for that. So these are some of the things that I've come across very recently. And there was even one startup which essentially offered services to assemble furniture and or put together equipments that you buy on Amazon or Flipkart. Um, because one of their things that they were talking about is how buyers lose out due to wrong assembly of some of these things that they buy on Amazon, or wrong installation of products that they buy on Amazon or Flipkart. So there are very unique problems that are specific to these tier 2, tier 3, or even to villages that are being addressed by startups. So this is actually a best time to be an entrepreneur in I mean in my lifetime, I would say, that I've
Right.
seen.
Yeah.
And wherever you are, it doesn't matter whether you are in Kerala or in one of the smaller towns, this is the best time.
Thanks, Seshadri. I think there is another question, not a question, probably, somebody's asking that whether we can connect you to LinkedIn. Probably, I think as an entrepreneur, that's not a question you need to ask. You should go and just try to connect it. That's it, straightforward. And I think Seshadri will be
Yeah,
very happy to connect you, right? So,
and I'll share my LinkedIn here.
yeah,
Um,
on the chat. So,
yep.
I think very, very, very insightful, very meaningful session today. Seshadri, thanks a lot. I mean, there might be a lot of questions in the minds of the people who have joined today, because a couple of things will be pretty new. But I think since you are a part of our ecosystem, we can anytime come back to you with any questions, or we can do a small sessions later on, clarify any of the doubts that we have. Right. So thanks for your
Yeah, sure.
time. Appreciate it.
And you can, I mean, any of you can reach out to me over WhatsApp.
Sure.
Usually I'm hesitant about picking calls, or there will be some delays. WhatsApp will get answered much faster, just because of the nature of how I operate. And thank you, Anil, for hosting the session, and thank you, Dr. Jain, for the
No
invite
worries.
and having me.
Thanks
And
a
thank you
lot.
all for the patient listen.
Thank you very much. And good night all.
Thank
Yeah.
you very
See
much.
you. See you
Thank
for
you.
the next talk series. Thank you.
Thank you.
Bye bye.
Thank you. Bye.